Good afternoon, everybody, and welcome to another in our series of Dafferns Wealth webinars. My name is Martin Gibbs. I'm one of the partners from Dafferns Chartered Accountants. This webinar is presented by Dafferns Wealth, which is our wealth management and IFA company. Dafferns Wealth is an appointed representative of Insight Financial Associates, who are appointed and regulated by the Financial Conduct Authority. And we're joined today for the topic this afternoon, which is equity release, by three of our colleagues from Dafferns Wealth. We have Rachel Legg, Steve Wheatcroft and Steve Kibler. So over to you, Rachel.
Thanks, Martin. Hello there. Being the only one not called Steve, I'll try and do this without sort of too much confusion. Steve Wheatcroft and I have worked obviously with Dafferns for many years now, but I've also worked with Steve Kibler for something like 12 years. Myself and Steve Wheatcroft deal with all areas of financial planning, but one area we don't deal with is equity release. And it so happens that Steve Kibler, this is his specific area of expertise. And we thought it would be really useful to explore this particular area so that we all understand actually what is it intended for, and it has come a long way since it was first introduced. So I'm not going to say any more than that, other to hand over to Steve. Just give us a walk through what equity release is and who it's suitable for. Thanks, Steve.
Thank you, Rachel. I've been a holistic financial planner now for nearly 20 years within the Insight Group, and I've been qualified all the way through that journey in equity release. It's evidently clear in the United Kingdom that most people's wealth, when they reach the age of 55 upwards and heading towards retirement, is actually within their main residence. And it's very, very clear that people, especially in today's world of uncertainty, low interest rates, where people are getting very little return on their saving, it's evidently clear that as part of a holistic financial plan, later life borrowing may well be a need that people would have to consider. And that ranges from people releasing cash for what you might deem to be luxuries in life, buying a new car, holidays, etc. But also at the higher end property value, there should be a plan in place to mitigate inheritance tax. So I deal with clients from the lower end need of just wanting money for enjoyment, those that may well still have residential mortgages but do not want to sell their home. Borrowing through the later life finance sector can help get rid of that issue for people, and also gifting to family. There are a lot of families at the moment struggling through COVID, where businesses are at risk and in fact people not being able to afford their own residential mortgages. And far from the bank of mum and dad, quite often the conversation could turn to the house of mum and dad, which can then release cash. So there are an array of solutions in the later life finance sector.
Thanks, Steve. Just generally, I think it's fair to say that there has been some bad press on equity release over the years.
Yeah, the market has moved on immensely, and you are quite right. Historically, there has been bad press, and the term equity release raises eyebrows for a lot of people. However, the journey towards later life partly is through education, where if the main asset of people is likely to be their house, and we are talking predominantly people's main residence for the purpose of releasing cash in later life, what's happened that makes it a more attractive proposition? Product innovation, for one thing. Interest rate, like the bank base rate. There's no direct correlation, by the way, with interest rates on lifetime mortgages, which is equity release, and bank base rates. However, there is a trend downwards. So interest rates are very attractive. Repayment features are also available in almost all products. All lenders that I deal with are subscribers to the Equity Release Council's Code of Conduct. A reassuring point of that is there can never be negative equity left when the homeowners have deceased. And if there's been interest rolling up, there can be no debt left in the estate. So always round, more flexibility, more options, more attractive interest rate, more features. There's normally a solution for everybody out there. My job as an independent advisor is to do the researching and find the right selection of lender for the right case scenario and your clients.
So Steve, you talked about flexibility of the different plans. I think one of the things that probably concerns people is the idea of their whole house ultimately going. Do you have the facility to sort of say, well, I would like this to sort of stop at half the value of my house, or certainly I want to be able to pass 100,000 on to my children. Does it give you that sort of flexibility?
Yes, it does. Equity release in terms of the amount that can be borrowed through a lifetime mortgage, it's defined by two key factors, which is the value of the property and the age of the applicant or the younger applicant if they're joint owners. For those that may be concerned about the rolling up of interest, interest can be paid voluntarily along route without any compulsion for the homeowner to do that. So that's an important point because the borrower, the homeowner, is actually in control of that decision. However, if they are not in a position to repay any interest and they are intent on letting whatever the interest rate is compound up, yes, there is a feature. It's an inheritance guarantee. If somebody wanted to preserve a specific value of their estate within their home that they know for definite will get passed to their beneficiaries, that is a feature that can be incorporated. It does have an effect on the amount that can be borrowed and the rates and the terms that are available, but yes, it is a feature.
Excellent. Thanks, Steve.
Yeah, one of the things I was keen to talk about today was just the fact that within the organisation we have got a series of specialists who offer advice on borrowing generally. So more general mortgage advice. It's useful to know that if they want advice or even a second opinion, if they've taken advice, that's something we're very happy to offer. So coming back specifically to equity release, a particular area that interests me is how we can use it in inheritance tax planning. Because clearly, one of the major techniques in inheritance tax planning is to make lifetime gifts, potentially exempt transfers. And so presumably in quite a lot of the cases that you deal with, the strategy really is to create capital that can support those lifetime gifts.
Gifting is becoming much more prevalent in the later life sector. It's a very emotional and it's a very costly process to go through what could be an obvious solution: sell the valuable house, downsize, and give away some cash. It is used under gifting rules quite legitimately. Obviously, in a financial plan, the sooner that's done, taking into consideration the 7-year gifting rule, the better. But I have had clients come to me very recently in their mid-80s, having conversed with their family about the what-if scenario of passing away last week, what would happen to all the wealth that's been built up. And as you will be fully aware, Steve, Rachel, the tax man is hovering over the estate.
And I know you've helped a Dafferns client recently, but in a very different area because they needed capital for a specific purpose. Can you tell us a bit about that example?
Yeah, that was a very sad scenario, actually, of an elderly lady who had lost her husband. And so it was a very traumatic and emotional time for that particular lady. She owned a very lovely house, unencumbered, had a lifestyle, and didn't want to move. However, a network of friends lived 20 miles or so away, and she wanted to stay in close association and contact with them. So the discussion went along the lines of discounting other options, including selling and moving down, if you like, to the area where her close friends lived. The actual conclusion that was reached was that she released equity from her unencumbered property and bought a second home solely for her own use. And she is so happy in her lifestyle because she's not had to move. She's got no dependents, actually, which helped the scenario and the solution. So she's got no immediate family or siblings. So all she's really done is release cash from her own main residence and stayed there and transported that money into another bricks and mortar asset, which is another house nearby to her friends, which she can visit as frequently as she wishes.
Thanks, Steve. You were talking there about maintaining lifestyle, and I think that's probably one of the key things that all three of us, that is the objective of our role. Financial planning is not just about achieving the best returns and that kind of stuff, but ultimately is about helping people to achieve what they want in life and, you know, have the retirement that they want and the lifestyle. So that's brilliant to hear how you've sort of assisted people in that. And personally, I can also say that, you know, you've spoken to a number of my clients, but not only only clients, but family, friends and family members. And you've been able to help those individuals enjoy the later stages of life. So thanks, Steve.
Yeah. Well, thank you very much, Steve and Rachel. I'd also like at this point to introduce you to Brian King, who's Dafferns' private client tax partner. Have you got any observations or reflections on the presentation?
Yes, comments were made that a person's house is one of the most valuable assets within their estate, but also a pension fund could be just as valuable. And from an inheritance tax planning point of view, I'm interested about the reaction or interaction between the pension fund and the family home. Because a pension fund can be passed down to beneficiaries outside of a person's inheritance tax estate, this may be an opportunity to not realise a pension fund, but take an equity release as a source of funding for retirement income. I know in the past the traditional approach was that the family home was sacrosanct and just like people relied on their pension fund and savings as a way of funding their retirement. But now it could be said that just like don't touch the pension pot, keep that for beneficiaries to pass on free of inheritance tax, and look at schemes such as equity release.
Yeah, excellent point, Brian, and I agree entirely. A lot of clients do now take the view that the pension that they've managed to build up is an excellent inheritance tax planning tool. And if you can pass it on outside the inheritance tax net, then equity release could be a very good way of creating the wealth that you need to enjoy your retirement and leave the pension fund intact. So excellent point.
Thank you, guys. That's been really useful. I think equity release may in the past have suffered from being misunderstood, but certainly we can see from today's presentation that there's a number of really interesting ways in which it can be used. Any final takeaway points, starting perhaps with you, Steve Wheatcroft?
Just wanted to emphasise the wide range of services that Dafferns Wealth can offer to help support Dafferns clients. We welcome any questions, any interest. We're always happy to talk about any aspect of financial planning with clients. We don't charge for any initial discussion or review, and welcome many opportunities to talk to clients.
If you have any questions, I'd like more information on Dafferns Wealth or equity release, please follow the link in the description to this video. Check out the dafferns.com website, and we will see you again on our next video. So thank you very much.